Good morning, everyone, being the two of you and everybody out in TV land. Welcome to the July 23rd meeting of the Trustees of Trust Funds. I'll call the meeting to order. First item on our agenda is the approval of the minutes of our June 23rd meeting. Do I hear a motion to approve them?
I'll move to approve, but I do have one suggestion.
Okay, well, I'll second the motion, and first of all, I guess I should say that we do have a quorum here, despite one of our members being missing, so we're officially in order. What's the correction?
On the motion to split the monies.
Yep.
I just think it might be helpful to have the explanation. The reason was for insurance, to indicate that we're exercising our fiduciary responsibility.
Which paragraph is that?
First paragraph, well, second paragraph.
Just that's
technically.
Chair Watson presented. Chair
Yeah.
Watson presented the trustees with two proposed actions.
Right.
That one?
No, it's
No, the one above it.
the one above it. So it says the CDs.
Oh, yeah, okay.
You know, just split the monies to ensure full insurance coverage.
Got it. Okay.
Okay, and I actually have a couple on the paragraph that says the trustees next recognize Susan.
Yep.
So on the second line, where it refers to, we reviewed a draft of the
Yep.
West Haven Metals Fund non-judicial settlement. We actually reviewed that document like 2 or 3 months before. So after fund and before non-judicial,
Yep.
I would put in petition to approve, because that's what we looked at.
Got it.
And then in the same paragraph on the 5th line down, where it says petition be signed and executed with the court, executed should be replaced by the word filed.
Okay.
Right. So I would accept your amendment as a second to your motion. Would you accept my?
I do.
Okay. With those changes, we'll vote on the minutes. All in favor indicate by saying aye.
Aye.
And the chair votes aye. Have that. So.
Thank you.
All right. So it's a different show and there's only two.
I know, right?
Okay, so the next item is a check we received from City Treasury relating to the Public Arts Trust, and this was the documents backing up the receipt of that check suggested it was the first payment from the 5-year capital improvement plan allocation for public arts at $25,000 a year. And this is the first check that came in for fiscal.
This is the second. This is the second check. We got one for fiscal year 25. This is fiscal year 26.
Okay, yep, you're right.
Yep.
So we just, we don't do anything with money, just vote to accept it.
Correct.
All right. Whatever.
Can I?
Yes.
Can I make a motion?
Yeah.
Want me to make a motion?
Why don't you?
I'll make a motion to accept the check as presented.
And I second that.
Okay, can I ask a
Yes.
question? But help me understand this process from the CIP.
Right.
So I know it's in the
It's
plan, but I didn't know they actually fund it every year unless a project was executed.
They vote, it's been approved by the city council. This particular item, I mean, the city has to make the decision, city manager has to make the decision to fund it. and the monies are there, so that she's, approved it after with the city council. The money's there, so they're now sending the money over. So,
Is that the way it works for every CIP?
No,
No.
because, so in some ways, this is more akin to the regular budget process where you only are doing it 5 years out, but because it's going to support the erection of a piece of art, I guess it's considered a capital improvement. And, but unlike most of them where, you go through the whole process and get the, requests for proposals, your high bidding and all that, and then you send out the money.
just they're moving the money over and then they go through the proposal depending on the size of the piece of art.
It's a little different.
It's a little
All
different.
they have to do is say, okay, now this just goes, they could do it anytime during the year.
Correct.
So that's what's happening. Okay, all those in favor of accepting the transfer of the funds into our trust, indicate by saying aye.
Aye.
The chair votes aye. So these will be unallocated. They're not tied to a particular project.
Correct. I know they're already starting to work on a project, but right now, this is just coming over and it's not tied to anything in particular. That is correct.
Will it, is the project the next one in Bohanko Park, or is that?
I can't remember what he said to me. It might be Bohanko Park.
Is the Michael Warhurst sculpture in the park?
Yeah.
Yeah.
Where is it?
It's in the middle of one of the fountains.
It's in the middle of the main fountain?
Yeah, it's in.
All the way to the left as you face the park?
Yes.
Yeah, okay.
It's like a marble sculpture, and it has sort of a flowing rhythm to it, so it rotates. But I think it sits there year round, so.
Yeah, I believe it does. Yeah.
Okay. So, the next presentation is by the TD folks, but that's not for another 20 minutes, so let's jump to.
Review of the expendable trusts.
Do you have a copy of this?
Is that the trust?
Yeah. But is that an extra copy? Can I have that one? Excellent. Thank you. This was great
Much
to have.
easier easier to read.
So this, when we were going through trying to make sure that we didn't have any commingling of private donations and city expendable money, Judy developed this, and then she and I used this as sort of a jumping off point to figure out which accounts needed to be switched from Bangor to Citizens and vice versa, or moved from TD into the Bangor accounts. All that has now occurred, so this is sort of like a photo shot of all the accounts as of the end of June. Now, some of those, when you look over the notes, the notes will tell you in what accounts the monies presently sit. So if it says endowment funds, that's the endowment fund that we have with TD. If it says scholarship, same thing. But then there's a couple where we haven't completed the transfer, for instance, of the CDs into the CDs yet. But those will all be worked out in the next 30 days, I would guess. But everything is now separated. I think it's clear for purposes of filing the MS9s and MS10s that we're all in order, so to speak. The reason I asked for this for today, and not that we'll make any decisions today, but one of my observations in working off this with Judy is that when these accounts were set up, presumably by Peter many years ago, they essentially fell into these four categories that don't necessarily drive anymore in terms of their primary purpose, that type of thing. So there are, the Prescott Sisters Trust is a single one, so that kind of makes sense. But then we have some funds that are, well, I should say the big one is endowment, is just sort of the whatever didn't fit into Prescott or the housing trust or the scholarships.
Yep.
And so my discussion with Judy that I wanted to discuss with you and we'll do with Peter is, I think for purposes of demonstrating what we have in different categories of funds, that without having to move them in and out of the actual products that they're sitting in, such as the endowment fund, we can recharacterize some of these categories. And so we'll know we have several items that are related to the schools or the library.
Correct.
We have the Prescott Park one, or the Prescott Sisters one, but we also have several park ones, and then there are things like the Public Arts Trust, which is, in some ways could be considered part of parks because it's an outdoor improvement in the city. So I wanted to suggest that we take a look at this and see if we can recharacterize some of these categories. And so I'm interested in knowing what you think about that.
I'm just trying to think how if it's recharacterized, they're all endowment funds. You're talking only about recharacterizing endowment funds currently classified as endowment funds?
The scholarships are scholarships, so
Yeah,
that's
yeah.
pretty set. So yes, you're correct. The endowment's kind of, like Tom said, the catch-all, where all the other, especially with TD, where all of the other investments kind of fall in that endowment fund. The housing endowment's totally separate. Prescott Park is totally separate. Scholarships are contained within scholarships. It's just scholarship accounts.
Where do we put this new housing?
Well, see, that's going to be the example I was going to say. So now we have this.
I classified it as housing. However, it does not sit with TD Investments. It will be sitting in separate CDs because of the expendable, non-expendable.
Okay, so because that was the issue I was going to get to.
Yeah.
If
So
how it affects TD's investment policy,
Yeah.
or our policy.
So what I'm suggesting is that we can recharacterize the nature of
Like a
the
subcategory.
purpose. It's really looking at the purpose. And combine some with others that are presently separated without changing the investment vehicle. So I would say that new.
It's internal accounting, like subcategories or whatever, so that when you look at the sheet, when you all look at the sheet, we've got somebody that's interested in parks, so that you can look right at the sheet and there'll be a subcategory parks. You won't have to hunt. Basically, it'll be right there kind of standing out for you. And then we want to see these four trusts because they involve parks or whatever.
Yeah,
Try to make it a little
exactly.
easier.
So it's not, don't think about where the money is being invested or sitting.
Yeah.
Think about if I was to do an annual report and I wanted to say, this is the amount of money that is currently under investment for housing availability, we'd pull up, those two, even though they'll never be in the same fund. And by the same token, if we want to set how much is related to,
Library.
well, library, we have like 5 different library funds. How much is related to parks? Now, there's one in which we have the Prescott Park, but then we have the Lower State Street Park. We have,
The Hovey Fountain.
so there are, it's a better, I think it's more informative to the public if they could see, I'm not sure the public really cares that much about where the money is invested, as long as it's being properly invested. But when I've talked to people, they ask questions related to, how much money is out there to support the public parks, that type of thing.
No, I think it's a good idea, but I think also we gotta be a little thoughtful about correlating that type of public report by classification to the reporting that comes from TD. So I'll use an example, the parks. We could have a nice presentation, annual presentation on this is how much money we have for parks, Prescott Park and all the Prescott Park plus the 3 or 4 others. But then all of a sudden TD comes with their presentation and
The amount's different.
and the amounts don't correlate.
So it'll be how we word that type of report, basically, is what you're saying, to be very clear and transparent.
I mean, in the case of parks,
Yeah.
it might be better because we probably could have TD shift shift them over into Prescott.
I think Prescott has to be alone per the AG's office. There was something, Tom and I talked about that.
So Prescott is the only fund that we have for which we received, I'm talking decades ago, permission to disperse based on a rolling
Yeah.
5-year average. And so that really has to be
Yeah, okay, I get it.
Standalone.
separate.
Okay, so there's a good example how it gets complicated.
Yeah, well, my observation is that it has become complicated. I'm trying to simplify it in some way. But, this example of, now that we've got some public arts trust money in a bank account, and then we got the rest of it in the endowment account, we're already in that situation now. This whole separation exercise is what's really brought it to.
And that's due to the states changing kind of their reporting structure. So that's why the whole thing, right, being
Yeah.
expendable and expendable and private.
Yeah, I'd have to think it through how, my
I agree.
mind is going to how it relates to TD reporting.
Right. And I think, that's why we're bringing it up now, because I think it's going to be an exercise and a process. This, as I put, this is just a draft, just to try to get things started and think about how do we move forward.
Because at the end of the day, TD reporting is not really comprehensive, all-encompassing.
Oh, it's not.
reporting.
Yeah, it's not. It's just for what's invested with them, so we've got Bangor checking, we've got a Bangor checking account, we have a Citizens checking account, we've got money at Bank Prov, so, we're getting ready to open a CD with TD, for 250 of the new housing trust, so it's,
So part of, I think, can be misleading to the public is that if you were to look at our reports, that you see, this is not all the money we have.
correct.
But anybody coming to one of these meetings would think, well, this is how much money they have, and that's not accurate, because we're
Would
not.
it help in my monthly reporting if instead of me just kind of regurgitating a little bit the TD dashboard, if I did a comprehensive instead and include all the monies from all the accounts and our total balance for the month? In other words, a lot of times what I give you, you get the dashboard anyways, which is TD Banks. If I take what I do and instead add in Bangor Savings, Citizens, Bank Prov for a total comprehensive number every month, would that be better?
From my perspective, yes, and that ultimately is, so part of what and I'm not articulating it as well as I should, I think, but, so part of what I'm thinking is that, there's a value when you do your thing because you're
I can add
comprehensive.
another, it's literally one more tab. I could just take what I've got and just add in another one. Once I get it set up, it's just, I don't wanna say
Well,
plug and play,
so-
but it's a plug and play. I'll take the numbers and put in whatever the bank statements say and it'll pop it out.
Well, so what I was anticipating that we could do with this statement is, once we got everything organized, then this would be available for a full summary with purposes and all that, but a reduced one that would have fewer columns could be done every month that would show how much is in each account.
Okay, but you have to remember, we don't post interest and capital gains and everything until year end. So all of the TD numbers are gonna stay the same and that's going to be different unless you want me to start posting every month gains and losses.
No, I don't wanna
Okay.
create a
So those
load of-
balances aren't going to change because we do it once because everything's so up and down month to month with the flowing, 1 month can be a loss, 1 month can be a gain. We wait until June 30th, have the actual numbers as of year end, and that we book those profits or losses based on that.
That come from
once.
TD?
Yes, one time. So I take the numbers.
They do it monthly.
They do it monthly, and that's what you see,
Yeah.
but I wait to book it until, otherwise I'd be taking money in, taking money out, across 86 trusts every month. In the past, it has always been a one-time shot at year end to get the total number for the MS9 and MS10. We have a good idea, but if I do that, that's going to add a lot of hours onto my time.
No, I guess I don't. Well, so I guess, from my way of thinking,
You need to think about it.
yeah,
Think about it.
so I think having this report
Mhm.
at the end of every year is very helpful because it really does, it's comprehensive.
Yep.
And so the only question is, do you just add on somewhere at the bottom every time there's a new fund set up or the city allocates some money for something? Or do we essentially reorganize these into different categories? It doesn't change what we're doing with TD.
I do think it's a good idea to kind of move towards a comprehensive reporting, as you suggested, Judy. I think that's positive, because like you said, Tom, it would be good for the public to have an understanding of all funds under the auspices of the trustees.
Yep.
But I also think it's critical that the public have the information to know investable asset performance. So those are
Okay.
two criteria I think we need to move towards.
Okay.
So when you say investable performance, you're also including the CDs and things of that nature?
No, I'm actually, in my mind, I'm not. I'm sort of
Managed funds.
managed funds.
Okay.
Because elsewise, you're gonna see performance that's virtually non-existent.
Yeah.
Because we have so many funds in CDs and I don't want people to think that we're falling short of our responsibility. Yeah, I think a lot of people are interested in, well, how are trustees doing managing city funds?
I mean, as you can see, the bulk of the trusts are managed by TD. You know, there's a handful that are not, but the bulk are managed by the investment funds.
I actually think going down your line of thinking,
Mhm.
it might be workable, just having 2 tabs.
Yeah.
Investable,
Okay, I'll
non-investable.
take a stab at it and then we can look at it and then tweak if you're like, nope, that's not clear enough, we can add what you think or what you'd like, add columns, take away columns. Let me devise something for next month and then we can kind of, at least that piece of it. And then Tom's piece is, you know, another piece.
Well, no, you know, particularly given that the, you know, the TD stuff is not posted monthly, you know, I see this as sort of a different project, and maybe it's I still think it would be helpful to have it organized, but
I agree. I think it's 2 projects. I
Yeah,
really
yeah.
do. I think it's what Dana is suggesting, a comprehensive, and then I think it's what you're saying is reclassifying it so it's easier to understand at a glance what's kind of there. Is it for parks? Is it for library? Is it for whatever categories that you'd like to come up with?
right. You know, so I think, you know, I agree with Dana that I think it's important for people to know, you know,
Yep.
what the performance is on the items that we're doing. But I think one of the things that happens is we only talk about the TD stuff, the result of which is that people don't get an accurate understanding of how much money is
I agree with that.
in our.
So if we add this monthly piece on, that will
Yeah.
help with that.
Yeah, so I think
Okay.
like a separate page or something that deals with the non-managed money.
Yeah.
Would be helpful.
Okay, I can do that.
And so in the meantime, I guess, and I'll discuss this we'll send a copy of this to Peter as well. If you could give some thoughts of how you would organize these. What I'll try to do is for the next time we get together, come up with,
Yeah.
I won't move stuff around, but I'll come up with what I think might be an appropriate list of categories.
So I'm curious, this has everything, right?
Yep.
But what's the total?
The total, I didn't put it because it's stagnant. These are the MS9 amounts right now sitting in
Oh,
there from
okay.
last June. I haven't
From,
June 2024 because that was the last hard close.
oh, okay.
So
All
that's
right.
why I didn't put the total
So
because I'm
you-
like, it's not even gonna be.
So even we, you know, and
Yeah.
to your point, even we as trustees,
Yeah.
how much money are we
Right, total.
total? We don't know.
Yeah.
Well, we
But
do.
you will,
Well,
we
we
do,
do, yeah,
we do.
but now you're gonna get a monthly report
Yeah,
of
which is
the
good.
total.
I think that's a positive.
Okay,
Yeah, I mean, you know, in the past, you could, you know, not down to the pennies, but, you know, there were only a limited number of accounts that we
Correct.
kept over in banks, CDs and stuff. But now that we've opened 500,000, and, I mean, the numbers start
It's
to
different.
diverge, and so.
so we'll change the reporting up to reflect all that. Okay, so when we come back, after TD's presentation, because I'm sure they're out in the hall, we'll get them. I wanna talk about the CDs if we can, we'll circle back to that.
We'll come back, yep.
Okay, perfect. Dana, did you, get this from the city clerk's office? They asked me, yeah, they asked me to give you a copy of it.
All right. Okay, thanks.
Thank you.
I've been remiss. Bad.
Morning.
Good morning, how are you?
Great, thank you. How are you?
Good,
You're missing one.
yes.
A little under the weather today.
Aw, that's too bad.
Is it just us? Are we on a microphone or anything?
I think we have a whole
we're being
new system
recorded.
here.
Yeah,
Yep.
yeah.
Well, nonetheless, I should still mention, had anybody gotten from Tom a suspicious looking email?
Not from Tom, from
Pete.
Peter.
From Peter, forgive me,
Yes,
forgive
he
me.
has been
We've got- I don't
hacked.
know.
Yeah, okay,
and-
okay,
yes.
okay, okay.
So we're gonna alert him, he's been hacked, so.
Yep.
I think he might know because I tried to send something and the whole account is down, so I think that he might be aware, so.
I got two.
I got
That
a lot.
instantly,
Venmo number?
Yeah.
what's that?
Wanted the Venmo, one of them wanted Venmo, and do we have Venmo?
It was I got that one.
Yeah.
Yeah, and then the other one was
Yes.
less specific, but
Yes,
anyway, okay, good.
yeah,
We have been so thoroughly trained on all matters, you know.
Yeah.
same here, yeah.
Yeah, which is a good thing,
Yeah.
but a sad thing that that's the world that we live in. It's relentless, as you know. Okay, I've got a couple of
All sorts of fun things in Washington.
Sure. Why I love coming up here.
Particularly in July, it's a little warm down there right now.
That's okay. Yeah, we'll
Steamy.
take them.
No, I said
Oh,
I
you
The
didn't?
most
They
humid
should be
summer
fine.
we've had in
Okay.
Really?
decades.
Really?
And
Wow.
I'm fine with
Oh, I
it.
They've
see,
got
I
them.
see.
That's
Okay,
The
good.
humidity
These,
that really
however,
becomes
that you
stifling.
did give them the JP
I still sit on the
Morgan,
porch,
so they
just-
don't need this.
They don't need
This is what I normally
have
send. It
fans
just
aimed
came out last
straight at
night,
me.
so
Okay.
I didn't send it to you.
Perfect, thank you.
But this is the one piece you don't have. And do you have a printout of what was sent last week?
No, I don't.
Okay.
Do you have one?
Is that this?
That one.
Yeah.
I'm gonna steal Suzanne's
Yep.
for you.
Take-
All right.
Yep.
Thanks. I did not print it, so thank you.
Yeah. Okay, I've got extras because, is Peter okay, by the way?
So, yeah, thank you.
All right, so I'd like to start with the main deck.
Okay.
And I will go to page 4. I'll remind you, as I always do, that this investment overview page is specific to the scholarship fund. All 4 portfolios are invested identically in the same model, so all these comments will apply to all of the portfolios. If you look in the table on the upper left, the top line total value, you can see the market value for scholarship at the end of the second quarter, so June 30th was just over 14 million. That is now closer to 4.3 million, so just quarter to date, the portfolios are all up about 1%. If you look at the pie chart to the right and the table to the right, you'll see a high-level view of the portfolio by asset class. I'll remind you that shades of blue in that pie chart are equities and shades of yellow and gold are fixed income. So you can pretty much instantly see you're at a 75-25 mix between equities and bonds. And then you get a little more granular view to the table to the right. On the equity side, the largest holding across all the portfolios remains a 55% allocation to what we call large cap core, which is specifically to your portfolio, the S&P 500. You'll see a 10% allocation to the large value dividend segment of the market, 5% to SMID cap, so that's small and mid cap stocks, and then 5% to international. And then on the fixed income side, of that 25%, the majority of it is intermediate bonds, which you see just over 15%, and then 5% in a short bond category. Very small allocation to high yield, it's 2% in total. I think over the life of these portfolios, it's ranged from a high of maybe 5% down to 2% now. And has been a nice complement to the portfolio. I'll show you more detail on that. And then cash, the cash target's 2%, but as cash builds over the quarter, you can see when this was printed at the end of June, it was just under 4%, but your model cash target is 2%. If you look at in the performance section, and we'll go into much more detail on performance, but just in preview, the third row down, so this is on the left-hand side in the middle, you'll see performance, and then the third row says quarter to date. So for the entirety of Q2 25, portfolios were up 7.6%. Really strong quarter. And now year to date, they're also up about 7%. So despite a tremendous amount of equity market volatility in the late first quarter and early second quarter, you'll remember all of the noise and nervousness around the tariff announcements. We had within the S&P 500, we were down about 20% in early April. That rebounded strongly by the end of the second quarter, and you can see that reflected in those returns. Right below that, unrealized gains and losses. I just point out to you in that top line that in aggregate, you've got unrealized gains in the portfolio. However, in this table, you can see it broken out between gains and losses. All of your losses are in the fixed income holdings, unrealized losses. We are chipping away at those as time goes by. This portfolio was built in the spring of 2021 in a very low interest rate environment prior to the fastest increase in rates that the Fed has engineered in our careers in 2022. And so we're just working those off, but you will continue to see those mitigate over time. And then below that, you see the yield, the overall yield of the portfolios of just under 2%. And that is, you're earning about 1.4 on your stocks and about 4.15 on your bonds. And so when you kind of put the weighted average together, you're just over 2%, which isn't bad. If you think over the last 20 years, interest rates were largely below 2%. So we're earning double that in very high quality bonds these days. Any questions on that before I show you the detail of the portfolio? Okay. If you turn to what should be page 6, you've seen this chart before. The portfolio is comprised of 10 exchange traded funds, and if you look at the far left column, you can see the names of them all. The first 3 are your stocks, plus the bottom one is also equities, and then everything in between is fixed income. I find it most helpful to look at the style name column in the middle, which is identical to what we just looked in the table on the previous page. But that top line is your single largest holding. Again, the target in the portfolio is 55%, but at the end of the quarter, just based on growth, it had grown to closer to 57%. And as you know, we rebalance the portfolio every quarter back to the target weightings. Looking on the far right, you can see the returns just for the second quarter, positive across all of your holdings. Equities the strongest, and if you just look at those top 3, you got the S&P 500 up about 10.5%. The large value segment, 3.6% for the quarter. That was basically the opposite of the first quarter, when your dividend holdings vastly outperformed the broader market because of the volatility that we mentioned. It was really kind of a flight to safety within equity markets. At the very bottom, your highest return for the quarter was mid and small cap stocks. That is really nice to see. We put that in the portfolio. We want you to have exposure to multiple sources of return. We don't want you to just be in U.S. large cap, even though that tends to have been the best performing segment of the market globally for quite a while. But this is a sign of a healthy market. When all companies are doing well, it's a good omen for the economy, and certainly good for investment returns. And then third from the top, third from the top, the 11.06 is your international exposure. And international year to date has kind of been the big surprise in terms of its overall performance. Now, that is not because Europe is growing meaningfully faster than the United States. The majority of that is the dollar is off about 10%, which just makes those foreign earnings stronger when you convert them back. TD at a high level remains kind of overweight US and underweight international in its model portfolios, and that's expressed here as well. So there's no recommendation to change any of the allocations. You've got a really nicely diversified portfolio. You're capturing the majority of your market returns in your S&P 500 holding, and the diversification remains pertinent. Just lastly, I'd point out in the fixed income holdings, from the fourth row down to just above the bottom row, pretty much just what you'd expect for quarterly returns based on your coupon income. We didn't have much of a change in interest rates over the quarter, and so the majority of the figures you see there are just a quarter's worth of coupon income. And consistent with my prior comment, your two high yield holdings, so that's second from the bottom, is a pure high yield holding. So those are fixed rate loans to below investment grade companies, was your best performing fixed income product at 3.71%. And then it's the fourth down from the top, 2.96. Those are floating rate loans to below investment grade companies, and that one was just under 3%. So again, those have been positive contributors to your fixed income performance, and are similarly very positive signs in terms of the health of the economy. If the lowest rated borrowers are doing well, it means in general the overall economy is doing okay. And then lastly, on performance, if you turn to page 8, just a higher level view of performance, but it shows you more periods. And so what I like you to compare here is, if you just look at the very top line, TWRR is the column in the middle. So for the second quarter, the scholarship fund was up 7.64%, and we can compare that 2 lines down to the, it's labeled COPIPS, so City of Portsmouth. That 7.9 are the target weightings in your investment policy. And so in the second quarter, you can see that the portfolio was about 26 basis points below the IPS target. Now, the one obvious thing that's not in your portfolio is there's no fees associated with the IPS target, so that's part of the differential. And then the other is the international underweight. So your portfolio has a 15% allocation to international versus the 5% in the portfolio today. And that's been a bit of a drag this year, not a big one, but a little bit of a drag because international's done so well. If you go down to the trailing 1-year period, you'll see your portfolios outperformed the IPS by about 4 basis points, and then similarly with the 3-year and the custom period. The majority of the outperformance of your portfolio versus the benchmark has been that international underweight. The other positive asset allocation component is we don't have any REIT exposure in the portfolio today. REITs were down almost 2% in the second quarter, so that's been a positive contributor within the portfolio. I'd like to think we'll get back to a day where a REIT allocation would make sense. To the extent that your portfolio largely depends on income generation for any of the distributions that you make, REITs are a nice alternative to bonds in that they have to pay out 90% of their income to maintain REIT status and the tax advantage status that they hold. However, real estate, just since COVID, has really been struggling in many sectors. Others in the data center space are doing really well because they're benefiting from AI, but it's been hard from an equity component to capture that in a concentrated way. So we remain underweight REITs relative to your policy, but I can see a time as values correct when we will add REIT exposure again.
Who makes that decision?
Us. I take recommendations from our in-house strategy team. And then to the extent that it makes sense for a client portfolio, I make that recommendation.
Okay.
Yeah.
Can you just
Nothing is preventing us, Dana, if you had a dream that REITs are going to outperform the market for the next year, and we wanted to add that, and no whistles or alarms are going to go off internally on my end with regards to not do that. We'll never get the timing exactly right, but anyway, the underweight
But
has
if-
made sense.
But if you had that dream, would you push to have the portfolio allocated accordingly?
I'd probably chat with my internal strategy team first, and we'd talk about it. Yep. Yeah, I have the benefit of having a team of roughly, 15 or so people whose main job is to determine the asset allocations within our model portfolios. I then modify those for each client's investment policy.
And just review again, for our investment policy, we're 15% target international, but we're weighted at 5% now.
Yeah, your policy is 10% in developed international markets, and we have a 5%. If you turn back to page, sorry, I printed these on. If you go back to page 6, the third row down, Dana, the iShares MSCI EFA ETF.
Yeah.
That 5% allocation, that's your international developed market exposure in the portfolio. Your IPS has a 10% target weighting. And then you also have a 5% target weighting in your portfolio to emerging markets. So that's
Which we have
which
zero.
we have zeros. And so that's the 10% underweight.
And
And then similarly, you have a 5% target in REITs where we have 0.
okay, so back to international, that underweight you're still comfortable with?
If I can now turn you to the market update deck, and it's got the asset class returns on the front page.
Oh, this one.
We're all done with,
Yes, yep. The remaining pages there are just the other portfolios. So.
Can I keep this, or Suzanne wanted to?
Oh, no, you can absolutely keep it. Yep. So on the market update, on this first page, if you look at the 3-month column, which is second from the left, I am broadly describing Q225 as a risk-on market versus the risk-off that we saw very early in the second quarter, particularly in April. If you look down the fixed income returns at the top, the second row down is the U.S. aggregate bond index, 1.2%. So similar to what you saw in your corporate and treasury holdings. And then at the very bottom of that table, 3.5 for high yield. And so similar to what we just reviewed in your portfolio. But again, when you see high yield outperforming everything, it's a sign of the risk appetite increasing within the fixed income markets. Similarly, down in the equity section, the third row down is U.S. large cap growth. So that is predominantly tech stocks, the tech stock segment of our market, up almost 18%, which was negative in the first quarter. And then value, big rotation out of value, up just under 4% in Q2. But if you go one column to the right, you'll see they're both 6% year to date, right? So that just shows you how dramatically value outperformed growth in the first quarter. And then below that, you can see the really nice performance that international has had. If you go over to the far right column, which is the longest time period shown on this table, there you can see, the underperformance of international versus the U.S. But over the last 1 year, international's made a strong comeback again on predominantly a devaluation of the dollar. And if one were to make a bet on whether that will continue or reverse, you can find arguments for either. I expect it to reverse predominantly on demand for dollars once all of the tariff negotiations are finalized. I don't see a scenario where we end up with less tariffs than we had prior. I'm hoping it's closer to 10% than anything meaningfully higher than that. But those tariffs will, if nothing else, create an additional demand for dollars on all of the imports into the country. And so we'll see how it shakes out. But it's hard to see the catalyst at this point in the year for a further depreciation of the dollar.
Even if interest rates get cut.
Yes, and you know, it's actually interesting that the dollar was able to sell off in light of the fact that the U.S. has meaningfully higher interest rates than the rest of the world right now.
Because of tariffs.
I really like page 2. It's showing you quarter 1 versus quarter 2 of 2025 sector returns across the S&P 500. So if you look at that table, each row, and you can see labeled by the different sectors in the economy, starting with information technology. Blue was the first quarter and green was the second quarter. And just those two top rows, you know, infotech and communication services, which also includes a lot of technology companies, just you really rarely see such a big turnaround one quarter over, you know, a sequential quarter. And then at the very bottom, you know, energy was the best performer in Q1 and the worst performer in Q2. So this is a great reason why you will rarely see us try to take, you know, TD, we have a saying, it's time in the market, not timing the market. It is just excruciatingly difficult, if not impossible, to on a quarterly basis, you know, time and get it right changes like this. So the broad diversification that you have really helps. But it's always interesting to me to see these dramatic changes, especially if you had told me, you know, at the beginning of the year about what would be taking place from a military activity in the Middle East, and most recently in Iran with the attacks on their nuclear facilities. I think 99 out of 100 people would have expected oil prices to rise. And, you know, as you're seeing here, we haven't seen it. So
Do you think is like AI driving some of the whole IT
absolutely.
sector? Yeah.
Absolutely. Yeah, and I'll show you a couple interesting charts in the other deck that speak to that a little bit. Page 3 is a nice kind of clean graphic of the yield curve. So by yield curve, I simply mean U.S. Treasury rates from 1 month on the left to 30 years on the right. And what this chart is showing you is just the change quarter over quarter. So in green is June 30th. So you can see we had a drop in rates predominantly at the 2-year part of the curve, and, you know, 10 years kind of unchanged, and beyond 10 years a little bit of an increase. But what you're seeing here is what the market's really been struggling with this year from a fixed income perspective is we went into the year with the expectation of rate cuts. Recall that the Fed cut rates from 5.5 to 4.5 in the last 3 months of 2024. And our own forecasts had them taking the Fed funds rate as low as 3% this year. We have since adjusted that to, I can't remember if it's 350 or 375. I think 375.
Yeah.
Does that sound right? Yeah, don't skip ahead. Yeah, 375. But what you're seeing here is the market's just been trying to figure out, okay, we definitely expect the next rate move by the Fed to be a decrease, not an increase. What's the timing of it and what's the magnitude of it? And so in the second quarter, the market kind of deemed, okay, you know, it's been delayed, but it's coming. There was some speculation that we might get a July cut. That's pretty much largely been removed. But the market, just by virtue of the fact that you have this inversion from 1 month to 2 years, is clearly pricing in, you know, further Fed decreases by the end of the year. And then if you turn to the next page, it shows you our forecast. And our Fed funds forecast is that top row. So we remain at 4.5 if you look at Q2. And then if you go over to Q3, you can see we've got 1 cut priced into the quarter that we're currently in, and then 2 in the fourth quarter, and then dropping to 3.25 by the end of 2026. So we have been constantly adjusting this. The big variable has been inflation just isn't coming down to the Fed's target of 2%. And if you look at the bottom table in this chart, the top, and you just look at the far right column, which gives you the averages for 2025 and 2026. That top row is real GDP. So 1.7% forecasted for this year, 2.1 for next. The unemployment rate virtually unchanged at just over 4%, but CPI, which is the bottom row, averaging close to 3% this year, and just under 3% next year. So, I'm not seeing the mainstream press use the word conundrum yet, but this is what the Fed's trying to figure out is, okay, we got tariffs. Generally speaking, tariffs tend to be inflationary, or at least, reflecting higher prices. The labor market seems to be holding in despite expectations for, certainly within the government sector, we don't see additions to jobs, but the overall economy is really holding in. So it's, the one thing I like about this forecast is I generally prefer rates where they are to lower rates. It's better for fixed income investors, but I can live with a world of 3% or higher risk-free rates in the treasury space. Below that, it really starts to hurt certain segments of the economy. And then if I can just segue from that into, I didn't know that I was going to have this deck until very late last night, so I distributed this deck from one of our partners, JP Morgan, to you. And much of it is a duplicate of what we just went over, but I did want to point out a couple of things. So we'll skip page 2. Those are the sector returns that we just looked at.
Do you need a copy?
Yeah.
Oh,
I have a copy of it.
sorry about that, Dana.
That's okay.
If I can ask you to turn to page 3. This is something we haven't gone over before. So this is the S&P 500 looking at forward PE ratio. So PE ratio is, if you look at the stock market and you ask yourself, well, is it expensive or is it cheap? Is it a good time to buy? Simplistically thinking, if you think about your neighborhood, you know where prices sell, and that's kind of straightforward. With stocks, the price alone is kind of just a number. What you want to know is what's the price relative to the earnings of the companies. And so that's the metric we call PE ratio. So it's the price of a stock divided by the earnings per share. And what this chart is showing you is that green line in the middle. This is just the PE. This isn't the price of the S&P 500. It's the forward PE. So the market says, okay, what's the S&P 500 going to earn over the next year? And what's that level divided by the current price? And that middle green dotted line is telling you that the 30-year average of this metric is 17, meaning the price is 17 times the earnings. And then the bands above and below that are one standard deviation from the average, which I know you remember from statistics class, covers roughly 2/3 of the observations are within those bands. Okay? That's, one standard deviation. So where are we now? We are on the far right at that green dot. So that's showing you that we're currently at 22 times earnings. And if you look at the table, it may be a more informative way to kind of compare. So that top line is showing you the forward PE, which is reflected in the graph. We're currently at 22 times earnings. The 30-year average is 17. So not screamingly cheap as comparisons go. That next measure down is the CAPE index, popularized by Robert Shiller. So that stands for cyclically adjusted PE. So one theory is, well, why do you want to look at forward earnings? That's just a guess. We don't know. We have estimates of what the S&P 500 earnings are going to be, but we don't know what they are. So maybe it's more informative to look backwards, and maybe it's even more informative just to take noise out of the equation to look back at like a 10-year average. So it's adjusted over time. It doesn't change it's a different number, but it doesn't change the fact that the current figure is above the 30-year average. And then dividend yield is the opposite in that the higher the dividend yield, the lower prices are. So again, all of these measures are showing you that the stock market today is not screamingly cheap. If you go back to the left, you can see it's certainly below the levels of the bubble at the end of 99 into 2000, but it's at the high end of the range. Despite this, the market's up almost 10% this year. And it's why we as a shop just strongly advise clients against trying to time the market. Sadly, not in our practice. Suzanne and I only work with institutions, but we know what's going on through the rest of the firm. A lot of retail investors bailed out early in the second quarter. The market was down 20 to 25%, and unfortunately, that was the exact wrong thing to do, right? So this chart is informative in terms of just kind of telling you where the market is, but it is not a tool to be used for market timing, that's for sure. Anyway, thought you might find that interesting. Page 4 is telling you why TD continues to be constructive on equity markets. And if you just look at the 3 on the far right of the bar chart, that's showing you estimated S&P 500 earnings growth for 2025, which started the year at 15%. So we have come down for the year. Current estimates are 9%. And then you can see 14% next year and 12% beyond that. So again, constructive for S&P 500 earnings overall. What this chart is in more detail trying to show you is the components of the earnings. And if you look at the table in the upper left, it's breaking it down by margin expansion or contraction, revenue growth, and then share count, right? That would just be buybacks. And so the bulk of the earnings are projected to come from margin expansion as you look at that table. And then the graph on the far right is showing you the overall margin across the S&P 500. And, it certainly looks high relative to the roughly 20-year time period shown here. But that gets back to your question or your point, Judy, about all of the investment going into AI. The bulk of S&P 500 earnings this year and in recent history have been from these large tech companies. If you think of a statistic, revenue per employee, how much money does a company make relative to the fixed costs of the people it needs to employ? These tech companies are just money printing machines in terms of their ability to leverage technology. The Facebooks of the world, their revenue is all ad revenue, and they don't need to hire thousands of more people to generate it, right? It's basically just computer servers. And so the success of tech companies in the modern economy, and as you know, tech is now like 30% of the S&P 500, has been driving this margin expansion. So this is just kind of a nice graphic as to one of the main reasons why TD remains really constructive on equities in this environment, despite all the volatility. And then there was just one other chart I wanted to point out to you here. Page 6 is just a nice depiction of the Fed funds rate. So this goes back to 93, and so that dark line is the Fed funds rate, which is the overnight rate that the Fed controls, that banks lend to each other at. And on the far right, you can see the easing that we discussed earlier from 5.5 down to the current range of 4.25 to 4.5. And then you can see various estimates. And I'll remind you, TD's was 3.25 at the end of 2026. So right in the lower end of the range that you see expressed there. And that was all the prepared comments I had. Again, not recommending any changes to the portfolios. All the decisions. You know, we had some conversations early in the second quarter around should we make any changes in light of what's going on. It was good that we did not, and based on TD's current kind of tactical asset allocation adjustments, your portfolio remains aligned with those. So, not recommending any changes.
Questions?
No, very good, thank you.
Always very informative.
Great to see you all as always. Thank you for having us in person today.
For coming in.
Having now?
Hope you have a great rest of your summer. The weather certainly turned our way.
Finally.
Yeah, yeah.
Now that I know that your decision-making is informed by the dreams you have.
No. You misheard me. It's Dana's
Well.
dream. You're gonna sleep better at night or worse?
Generally, I don't dream about what's going on in the markets, but, you know,
You do when it's down 20%.
no, those are nightmares.
Those are nightmares.
Oh, yeah,
Those are
that's
nightmares,
true, that's
exactly.
true.
Yeah.
Yeah, great.
Thank you again for your time.
Great, thank you, very good, helpful.
Anything we need to know? Distributions, liquidity needs, anything?
I don't know of any
just had a
right now.
couple.
We just, usually it's, you know, at the end of a quarter, we had some in June, won't be for a bit now. If, you know, I am starting to cut checks for scholarships that time of year again. And, but again, it won't be for, until I have a better handle of how much we're gonna need to cover, so, yep.
Well, thank you again.
Good, thank you.
Thank you.
Travels back.
It's always nice and easy.
Take care, everyone.
All right, see you
Bye.
later.
Okay, so on the CDs, I have the signature cards for the TD for 250,000 for the new low market trust. You had voted to go with 2 CDs for that 500,000. I've got the signature card for TD, and I need signatures, and I'll need Peter's signature. And then once we
Were
have
they
that.
6-month TD?
I'm
CD?
waiting to see because they go with the rate when they receive the check.
Yeah.
And it's kind of a flux between a special 5-month they have and a 6-month. The last time I talked to them, the 5-month was worth a little bit more than the 6-month. So,
Okay.
you know what I mean? But it'll be
One
either
or
the
the
5 or the 6, correct. I have that. My question to you, and Tom and I had a brief discussion about this. The second CD, you had voted to go with the top two, and the second one was with Bank of New Hampshire, had a high rate. When I talked to them, they would not send me signature cards or even begin to set up. They want all 3 of the trustees to come into the office. They're located in Dover. They're like, we haven't dealt with them before. So my question to Tom, and he said we'll need to bring it back to you all, is do you want to do that, or would you rather just go to the next CD in line? And the next CD in line is Newburyport Bank, who we do work with. So I'll probably.
What's the rate on the Bank of New Hampshire one?
Bank of New Hampshire at the time, I don't know what it is today, was 4%. Newburyport, which is the next one in line, is 3.5. Or do you want me to look at money market accounts and we'll put half of it in a money market account? What would you like me to do at this point? I can go back out and do a whole nother recap of rates for the second piece.
Then we're just timing it again. So part of my concern is if we go with Bank of New Hampshire and 6 months from now,
Right.
we want to move it, Dana's in Florida.
Yep.
And, you know, now
It's a
we're stuck
concern.
with.
They were funny because they've never dealt with the trustees before. They're like, you know, we've never dealt with the city of Portsmouth. We don't. I was like, okay, you all have to come in. That was their thing, and I was like, okay, that's fine. You know, I'll get back to you. So And again, the city manager had said, 6 months for some of the money, she thinks maybe they might be coming in. So my question is what do you think is a better course of action? I can go out and check the rates again, and then we've got 250 that are going into a CD. For the other 250, do you want me to look for another CD and get the rates again and take Bank of New Hampshire out? Or do you want me to look at money market rates and see if we can find a money market or some kind of a checking account or something that's got a higher yield? And that money's more accessible so that if the city wants it, we can pull it easier. Oh, I guess I'm just asking you, what would you like me to do?
My only concern about, if you go out and look at rates, that means it's not until August that we're back.
I
Deciding
understand.
this again.
Do you want me to start with Newburyport Bank then? Is that the next option?
Yeah,
Or do you wanna leave it, do you wanna just leave it in Bangor Savings for now?
but what are we getting there?
Not a lot.
Do you have a preference on this?
I would move it to Newburyport.
Yeah, that's what I'm inclined to say.
I have a very good relationship with Newburyport. We've dealt with them. They had the Daniel Street Trust monies and they were very, very good to deal with. I can reach out and get that going right away.
Yeah.
Okay, I will do that.
Will it always require all three of us to do it, or?
I think so, but I think that if I remember correctly, they do it like this because they've dealt with this before. They'll send me the signature cards, and then we get the signature. The only thing is going to be when we need to get the money out of Bangor, you're going to have to go and get the money, a check for me, because I can't withdraw funds.
But it's really just setting up the accounts that's the
Right.
stumbling block. Okay.
Correct. Yeah. So I'll reach out. I'll give her a call when I go upstairs.
Okay.
Okay. All right.
That would be for 6 months, basically.
Yes, it's a 6-month CD, yeah. So here are this is for TD's CD, okay. Tom, you're gonna be in this box here.
You just need a signature, or do you need
Just
me
a
to write
signature.
addresses and all that?
No,
Okay.
that's all here. I've already done that part for you, so I just need a signature in the box and then the date,
And today's date is
23rd. Okay, and then this one as well, line up here. Okay. I don't know if you don't get the agreement, it's just a TD with their novels for the agreement. Do you want me just to, I'll just keep it with it.
Yes, yeah, hold on.
Is that yours?
Those are mine, yeah.
Can I steal one?
You need one? Sure.
I just stole one.
Oh, okay.
Yeah. Okay. So Dana there. Yeah. And then on this one and this box here. Something to do with the electronic.
This is TD.
Correct. Yep, thank you.
Thank you.
And I have a bunch of scholarship checks.
Fun.
For you. For you.
These are always fun to see
Yeah.
what's going on.
Yeah.
There's Patrick getting some money. Wake Forest, a smart guy. West Virginia.
University of, or?
West Virginia University. Interesting. Fairfield.
Just so you know, this is only, what you're citing now is only a third of what was awarded out, so more will be coming in next month, I'm sure.
Yeah. If you, if it gets because of deadlines of having the money in, just let me know and
Can I
a couple of us can come by.
reach out?
and-
That would be
Yep.
great.
Yeah, I'm pretty much available.
Okay, that would be great.
Purdue, haven't seen one of those in a while here. Checks feel thick for some reason.
I'll check, but I won't let either one of you go until I check to make sure I have 2 signatures on everything.
Wonder how kids are making their decisions on where they're going these days.
I don't know.
Or is it all US and World Report rating?
Yeah, honestly, don't know. I mean, I know a lot of schools have started to cut courses and stuff because of funding. So I suppose it would depend on if you know what you want to major in. Make sure that they still offer the courses you want.
Yeah, well, that's part of it. But, a lot of it is, somebody gets it in their head that they want to go to
Mhm.
California or someplace.
Yep.
Um,
Yeah, sometimes it's location driven. Oh, sorry, Tom.
It was a great party school when I was in school,
What's that?
University of Vermont.
There's a couple more too. Add to the pile.
Did you go there?
No. But when
You
I
had
did,
friends there.
Surprised I haven't seen more University of Vermont ones.
Yeah, there's.
Usually it's popular choice.
South Carolina.
Guess when you compare it to UNH tuition,
Yeah.
it's a,
Vermont was always high. But it was, skiers, everybody was a skier wanted to go there. When I was in school. Feel like you're watching the pot boil,
Kinda.
we have somebody that's gonna come in and take us out of here.
I don't know if there's a 9 meeting or not. Can't remember if it's on Wednesdays.
Another good ski school, University of Colorado Boulder.
Yep.
You don't see a lot of the Big Ten schools though. Purdue is the only one I really saw. You don't see that, those big middle,
The big ones.
yeah,
Ohio State,
yeah, exactly.
yeah.
Michigan. Anything else?
Nope, that's it for me.
There's nobody from the public here, so there will be no public comment today. I would entertain a motion to adjourn when you're finished signing, Dana.
Good timing. I will move, we adjourn.
And I second. All in favor?
Aye.
Ayes have it.